There are lots of well-known adages in markets. Two that seem particularly pertinent to today are don't fight the Fed and never count out the US consumer. The Fed has been shouting it from the rooftops. Growth needs to slow in order to combat inflation. And they're backing this with action. Aggressive action, to say the very least. We haven't seen this level of aggressiveness from the Fed for 4 decades. The US labour market is too tight, therefore the Fed are raising rates to slow the economy, generate some unemployment, and take the heat out of wage growth. They've told us that, effectively, they're prepared to cause a recession to stamp out inflation. Thus, they've landed themselves in a tug-of-war with the US consumer, a force to be reckoned with. In truth, the resiliency of the economy today is broader than just the US consumer. But the willingness of households to spend savings they accumulated from government COVID support packages has been important during the cost of living crisis. And if consumers spend, then businesses are able to continue hiring and increase wages, and so the circle continues. So far this year, both adages have been correct. Economic growth hasn't rolled over in the face of the energy crisis and higher rates. The doomsayers were too pessimistic. But markets haven't taken kindly to the Fed's aggressive tightening of monetary policy, driving bond yields up and equity valuations down. How much longer can this game of tug-of-war continue? In the July video, I asked, are we nearly there yet? Then, as now, I think we have a little way to go. At the margin, the Fed has started to win. We've seen tentative signs the labour market is weakening as fewer people are prepared to quit their jobs, as companies advertise for fewer new workers. Inflation data has started to turn, but it's still far too high. As these forces build, we're starting to see some interesting opportunities in markets. Yields on corporate bonds, both higher rated investment grade and lower rated high yield, are starting to look interesting. They benefit from the combination of higher yields induced by the Fed's actions, yet support from the strong consumer. Moreover, as yields have risen, so the cushion against further rises in yields has improved. But the issue is if the Fed do cause a recession, which at the moment seems necessary to stamp out inflation, then corporate earnings forecasts need to fall further. So the battle continues between these two adages. All in all, interest rate expectations are now more fairly priced, but the potential for more persistent inflation or a significant recession is not reflected in valuations yet. The good news is that we have seen a significant adjustment in real yields, but now we need to see evidence of more realistic corporate earnings expectations and that higher rates are starting to slow the labour market. Patience continues to be a virtue.